What is a tax shelter and how does it benefit you fiscally? Instead of seeking increasingly obscure and possibly shady ways to reduce your tax liability, why not stick to proven tactics like investing in real estate, itemizing your deductions, and saving for your retirement or your kids' college? Decisions made just to lower fiscal debt without factoring your overall financial health and goals into the equation tend to be suboptimal decisions anyway. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. I'm doing marvelous. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about a tax shelters in general, and how they benefit you fiscally. A tax shelter is a place to put your money where it will be safe from the long arm of the taxman, the IRS, and many state tax authorities. Many people think of tax shelters negatively, but they are completely legal and legitimate ways to decrease your taxable income. Congress has made things that way, so it is legal, it is legit. Common examples of tax shelters are home equity and 401k accounts. Now, a tax shelter is different though from a tax haven, because a tax haven is a place outside of the country where people can stash money in order to avoid paying U.S. taxes or the taxes of the country where they're located. Now let's talk about two types of tax shelters here. Deductions. Now, this is a tax shelter that allows you to minimize or eliminate your tax liability, either permanently or temporarily. For example, if you make a donation to a qualified charity, you itemize your deductions, and deduct that donation reduces your overall tax liability in that particular year. Remember, if you make a donation, you have to itemize. You can't just use the standard deduction. You'll never have to pay taxes on the money you gave to your favorite charity. Of course, the charity has to be 501c3. In other words, it has to be approved by the IRS. You can also deduct extraordinary medical expenses, mortgage interest, and student loan interest, to name just a few tax liability minimizing strategies. Right? So the bottom line here is that those are tax shelters. Those deductions are tax shelters because they allow you to ultimately pay a lower tax amount to the IRS and to state tax authorities. Let's go now to the second tax shelter I want to talk to you about: retirement accounts. Now, whether you're talking about an IRA, an individual retirement account, or a 401k, a tax-deferred retirement account is also a tax shelter, though not a permanent one. So, when you contribute to a 401k or a deductible traditional IRA, we've spent a lot of time and a lot of shows on IRAs and 401ks and Roth IRAs and Roth 401ks. So you might want to double check our series on retirement, personal retirement, to learn more about that topic. So I was just actually talking about the fact that if you contribute to a 401k or a deductible traditional IRA, your taxable income is reduced by the amount of your contribution, because the deduction is pre-tax. So your money grows tax deferred, meaning that it can accrue interest and earnings that are not taxed from year to year. This is not a permanent tax shelter though, because you will need to pay taxes on that money at some point, and the IRS will collect income tax once you start taking distributions in retirement. Right? Now, the thing here is that the logic behind the retirement account being a tax shelter is that authorities and most people, experts, believe that your income tax bracket in retirement will be lower than your income tax bracket in your active years, so that you are paying less taxes on the overall amount, on the overall amount being deferred and being invested for retirement purposes. A 401k and traditional IRA are not the only retirement accounts that offer shelter from tax liability. You have something called a 403b retirement account, and this goes by the name tax shelter annuity. So employees of public schools and certain nonprofits organizations are those who may have access to a 403b plan. And similar to a 401k, a 403b lets employees contribute pre-tax dollars to a retirement account that grows on a tax-deferred basis. Again, anything that is retirement oriented is not a permanent tax shelter. It is a temporary one because sooner or later you're going to have to pay taxes on them. And this is different from a deduction. A deduction is a permanent tax shelter. Once you deduct, if you deduct your mortgage interest or your medical expense or your donation or your student loan interest, this will reduce your tax liability ASAP. And this is a one-time thing. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're also having a conversation today around what a tax shelter is and how does it benefit you fiscally. Let me give you another tax shelter. Before I do this, I just want to say, if you love the content that you are hearing today, you love the clarity and the quality, please consider subscribing to our channel because we have much more, many more shows coming. And turn on the notification bell so you are aware when we release a new show. Also, like this content, share, and comment below. Home equity. Now, home equity is a great tax shelter. One of the reasons that buying a home is such an important financial milestone is that home equity increases your net worth. So while paying down your home mortgage is liberating financially and emotionally, if you never sell your house, you will not reap the benefit of that home equity unless you take a home equity loan or a home equity line of credit, right? So if you do sell, though, you'll see why home equity is such a valuable tax shelter. Home equity, just for those who are not familiar, let's say you buy a home, you buy a house for $500,000, and you buy this, and after 20 years, the house value jumps to $750,000. The home equity is the difference between the market value of the house in the moment versus how much you paid for it, or how much mortgage you have left in the home, in the house. So if, let's say, for simplicity's sake, if you owe $500,000 on the property and the property is worth $750,000, your equity is $250,000. So that's $750,000 minus $500,000. All right. So the IRS exempt the first $250,000 or $500,000 for a couple of home sale profits from capital gain taxes. You heard it right. The IRS, the agency, will exempt you. So that's just pure profit. So you and your spouse could reap a $500,000 profit from a home sale and not pay taxes on it. That's just beautiful. This is a great tax shelter. I'm not even talking about the fact that you have already garnered other tax shelters while you had the house because you were paying mortgage interest, right? So that's just a double win. Let's talk about investments. So if let's say you are already on track with your retirement savings and you've taken all the relevant deductions and you still have money that you want to shelter from the IRS. If that's the case, there are a few tax sheltered investment that you can turn up to. So let's say, for instance, if you're in the high income category, you can make foreign investments, and foreign tax credits can reduce a chunk of, it can really actually reduce a huge part of your tax bill. And then you also have tax-free municipal bonds, which earn tax-free interest. So you have a whole array of investments that you can allocate your extra funds to, and evade, quote unquote, not evade. Evade is a bad word here, and not pay taxes, because evasion has some kind of negative connotation in the fiscal literature. So we don't want to use that. But my point is, you can invest your cash in securities such as tax-free municipal bonds or foreign investment and other types of investments, and by doing so, you're not paying taxes, or you're paying a smaller amount, a reduced amount of taxes. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Sweetie Kiwi Show. And we are still talking about what is a tax shelter and how does it benefit you fiscally. Not physically, fiscally. Let's talk about college savings plans. Now, the popular 529 college savings plan is both a tax shelter and a way to save for your children's education. So states and educational institutions, colleges, universities, they sponsor 529 plans, thereby allowing parents to save for future higher education costs. Now, we all know that in America, education costs, tuition fees are just like crazily high, right? So you need to start preparing for your kids' academic future now. So earnings from those savings, I'm talking about the savings in the 529 plans. The earnings from those savings are not subject to federal income taxes if they are eventually used for qualified educational expenses. So in addition to being a tax shelter for federal income tax purposes, some state-sponsored 529 plans also allow savers to deduct their contributions from their state income taxes. So you're able to reap benefits twice, at the federal level and at the state level. All right. So, folks, this was the conversation today. I wanted just to talk to you about what a tax shelter is and how it can benefit you fiscally. Let's sort of recap here. The 5 tax shelters that I spoke about today were deductions, retirement accounts, home equity, investments, and college savings plan. Now, let's just sort of qualify today's conversation by saying that sometimes tax shelters can go wrong. In other words, people might try to abuse the system. So people who stretch the law in pursuit of tax shelters, they will find themselves facing the IRS, and not only the IRS, but the full force of the United States government. I'm talking here about penalties, possible prosecution, and even a prison sentence. So if you try to take deductions you're not entitled to, the IRS could catch you in an audit. And this is really bad. This is bad. So you want to stay away from that and beware of people or companies offering to hook you up on a tax shelter. No. So according to the Internal Revenue Service, these groups often promote tax schemes in violation of the IRS code. They'll offer to help move income you earn into accounts linked to a foreign debit and credit cards, for example, thereby dodging taxes in the process. Like many things in personal finance, if it sounds too good to be true, it probably is. Always try to comply with the law. Comply with the law. Get the best specialist around you. Hire a financial advisor. Get a tax attorney. Get the CPA, someone who understands what the law says and can interpret the laws to your best advantage. That's the optimal approach here. All right? I will talk to you another time. But until then, remember, stay marvelous.